Welcome to the Money Runner. I'm David Nelson. This is a hot mic broadcast. It's really going to be audio only. I wanted to get my thoughts out quickly regarding today's Fed meeting, the March meeting. Coming into the meeting, one of the things I noticed when I scanned the street for research was that a lot of bulge bracket houses, in particular Goldman and some of the others, were cutting expectations on how many cuts we were likely to see this year. An hour before the release, expectations for a June cut were somewhere around 60%. At the start of February, a June cut was a lock, well over 100%. All economists, coming into this meeting seem focused on the dot plots. How many cuts can we expect this year? And needless to say, this has been a fluid number. We've been pushing this out for well over a year. I've been wrong on this call. I was looking for cuts last year. That was obviously wrong. And I've almost had to push out my expectations month after month after month, right? Prior to the call, I did my usual scan of the networks to see what, some of the talking heads have to say. So Dr. Kelly is one that I really admire. I've been on air with Dr. Kelly. Dr. Kelly, for those who don't know, is the JP Morgan chief strategist. He said the following on CNBC: "It's a good sign that the Fed could slam on the brakes over the last 2 years and the economy could take it. The real question is, what is the neutral rate?" And the neutral rate is really where the Fed is not accommodative and they're not restrictive. What is the neutral rate? And it appears likely that it's north of 3%. Previously, I think the thinking was, somewhere around 2.5%. So we'll see where we come out on that, because that's going to be important as the months roll by. The statement comes out, midday, and not much change in that at all. Right out of the gate, in the conference that followed, right out of the gate, Powell said the Fed is likely at peak rates. So he put that, really aside very quickly. He also indicated they expect to see the first cuts sometime this year. What sometime this year could mean? Does that mean 1, 2, 25 basis points, or 50? Is it 2 cuts, 3 cuts? We don't know. And that's the part of it that's really fluid. This is really important take from the Q&A, I thought. Powell is well aware that the risks are two-sided and that they're trying to thread the needle. And what does he mean by that? Well, you cut rates too soon, you risk inflation coming back. Cut too late, and you have a policy error. And you're going to have half the street, including yours truly, saying, "I told you so." The other notable statement made during the Q&A was that it will be appropriate to slow QT, or quantitative tightening, soon. In other words, we can expect the Fed to cut back on the reduction in the balance sheet. And that's been very restrictive. I forget what the figure is, but they're rolling off, billions a month, every month. That's liquidity coming out of the system. They slow that down, and that puts liquidity back into the system. The one statement that was reiterated over and over again is the Fed is strongly committed to getting inflation down to the 2% target over time. And that's the key word, over time, because it does imply they will cut rates before they get to the 2% target. And that can help them avoid the policy error that so many of us fear. All right, that's it for this call. If you missed anything, the transcript is right in the email. And of course, feel free to reach out if you have any questions. Thanks for joining the call today. I'm David Nelson, and this is The Money Runner.